The Reserve Board met today and they've kept interest rates on hold. That's after dropping the cash rate by 25 basis points last month. Now they're looking for a lead in terms of where they go next. Most people are predicting it's going to go down. In fact, before this announcement, 38 economists were surveyed and they all anticipated rates to be on hold because we're already in what would be considered emergency level uncharted territory in regards to our monetary policy. So what are we looking for? Well, I think internationally we're looking for leads in terms of what's happening overseas. And all the leads are pointing to lower interest rates. We're seeing Brexit put pressure on the UK economy, and we'll probably see the UK drop interest rates. That's also then arguing for the European Union to potentially do the same thing to shore up confidence around that economy and that broader economic community. We're seeing Japan also look for further stimulus into their economy. And we're seeing China also trying to stop the slowdown and trying to transition to a more prolonged growth level and a more sustainable level after an amazing run of rapid growth in their country. What's bucking that trend is the US. They're in an interesting position. Their payroll data has been quite positive the last 3 months, although the latest release last week was a little bit softer than most anticipated. On the whole, we've seen hundreds of thousands of jobs created over that period of time, and that's leading to potentially the Reserve Governor there looking to talk about raising rates again. And I think we're starting to see that as coming the time where we will see the Reserve Governor, Janet Yellen, actually do something about rates between either at the end of this year or early into the new year. Now, she'll let the marketplace know about it because they obviously get quite jittery when we are starting to see that. And that will put pressure on the US dollar, and that will hopefully see the Australian dollar come off its highs. We've got a very stubborn exchange rate at the moment. We basically need to see that come down. Ideally, around that 70 cents mark would be perfect because it will allow our economic and exporting activity to start to take further shape. It will also mean that obviously what we import will be slightly higher. So there doesn't seem to be the same concern around inflation as what there was when we saw that negative inflation piece only a couple of months ago. So domestically, the leading economy is looking quite okay. We're starting to see, or we have seen, a pretty good employment number. We're seeing our job numbers or unemployment sitting around 5.75%. Now that's pretty good. There's definitely spare capacity, and we are seeing in terms of the trending data that there are more part-time jobs being released or created as opposed to full-time jobs. But on the whole, we're feeling pretty comfortable. We've seen some surveys about consumer sentiment and actual consumer spending has been pretty good. So we're not sort of going into our shells, which is good news for the economy as we try and strive and get through the other side of this. In terms of GDP numbers, in the past, we've really focused on those GDP numbers in terms of how the economy is performing and the jobs that they create. But what's going to be interesting as we've gone through the phase of our mining boom and we're now coming into the production phase of that, it's taking less workers to produce the same amount of cash flow positive into the economy. So we're actually going to see that GDP numbers might grow back to that 3 or 4%, but we won't necessarily see the number of employees needed to actually produce that. So we're going to have to look for different measures in terms of how we're seeing unemployment drive forward. Our construction industry has been quite robust, and this is where I want to spend a bit of time. We aren't seeing wage growth pressures at the moment, and that's obviously tapering our inflation story. But what we are seeing with low interest rates is property prices continue to move higher because we've got a little bit of confidence about job security at the moment. Now, I'm going to flag this as an early warning, and I've said this a couple of months ago, is this rising tide that's lifting all the ships higher in terms of our property prices is going to come to an end at some point. Now, the first triggers, as I've warned you all before, it's going to be in that high density apartment market when we start to see prices come off there and we start to see, higher vacancy rates for less renters going into those markets. But I'm also concerned about the outer suburb areas as well. When we start to see this price growth, and if we're not seeing income growth underneath that, the price will hit a ceiling. They won't be able to grow any higher. And when the economy starts to falter, those particular prices will be exposed to a correction. And this is normally what's going to happen in terms of the cycle of a market. We normally always overshoot and then we come back down. So it's important that when you're actually picking your property and where you're going to live and what you're going to do, there is going to be some price movements, most likely on the negative in some of those areas. Some of the inner city areas are still doing very well as confidence grows and incomes are growing for those people living closer in, and they're putting price pressures on those particular properties. So the existing 3 and 4 bedroom houses are performing very well in our major capital cities and continue to deliver very, very strong price value growth. Now that will ultimately come to an end at some point. When that is, it's very hard to pick because we've got the economy being well managed to a point of what can be controlled. There's still some lever, a little bit of movement in the monetary policy, but we do want to see fiscal policy start to take shape. So that federal government needs to do and outline their agenda and start to look at that infrastructure story. Otherwise, we'll come in for a harder landing than what's needed. But right now, interest rates on hold, maybe some pressure internationally to drop our rates just to keep our cash rate and exchange rate at a competitive level. That might be the next force to force the governor and the bank to basically move cash rates lower. One final point goes out to Glenn Stevens. It's a big shout out to you. You have done a fabulous job in managing monetary policy. You and your board should be highly commended in terms of the work you're doing. You are world class and you have navigated our economy through very tough times. You know, the GFC, basically the worst financial meltdown event in almost 100 years. You got us through that beautifully, and congratulations to you on your services to the government and also to the country, because you have made households wealthier through prudent policy measures. Congratulations and enjoy your retirement. And that's it for me today.